Welcome to Tim Talks Private Equity and Venture, where Tim Cunningham sits down with leading GPs and private markets professionals to explore the dynamic world of private capital. Since 2002, Tim and his team at Touchstone Group have been at the forefront of raising capital for buyout, growth, and venture funds. With decades of hands-on experience working alongside private equity and venture LPs and GPs, Tim brings deep industry insight and expertise to every conversation. Join us for candid discussions with GPs who are shaping private capital today. Now here's Tim.
Hey everybody, this is Tim again, and today we've got a really cool guest. This is Kelly DePonte. I've seen Kelly at industry events over the decades. He and I share a long provenance in the industry, and he's really been at the center as an investor, fundraiser, advisor, educator, and I guess expert witness as well. And I'm not sure how much expertise is valued these days. Sometimes I wonder. But working with primary funds, funds of funds, co-investing, secondaries, private equity, venture, private credit, infrastructure, real assets, the whole gamut of illiquid alternatives. And I think for 23 years, he was with Probitas, which is a high-profile placement agent. And most recently, when he left Probitas, I think he had been running their research operation for quite some time. So he's been digging into the data and understands the industry better than almost anybody I know. He also publishes an annual survey of institutional LP trends, and we're going to get into some of the results of that today, and teaches investment due diligence and private market related stuff for various industry bodies. So 34 years in private markets. This is a real treat to speak with Kelly. Before you did this stuff, give us a little of your background. Where'd you grow up and go to school, and kind of what happened before you got involved with private equity and venture?
Well, I was born and raised in Hawaii, and I'm actually part Hawaiian, one of the few part Hawaiians in private equity, though there aren't that many part Hawaiians all in the world overall anyway. So I went to Kamehameha schools in Hawaii, which is a school founded by the last of the Kamehameha dynasty to support education for Hawaiians. After graduating there, I went on to Stanford, got my undergraduate degree in TV and film. So by my undergraduate degree, I'm most qualified to be either a television news broadcaster or a film critic, one or the other.
Okay. I
had always been, even when I was in high school, involved in managing organizations. I was an actor, but I was also the president of the Thespian Society there. So I decided what I really wanted to do was get involved in business, and sort of retrofitted myself after Stanford, and got an MBA from UCLA. And that led to a job in commercial banking and investment banking. The first big thing I was responsible for at First Interstate Bank, while it still existed before Wells Fargo bought it, was interest rate swaps at the very, very beginning of the market, when you actually had 50 basis point spreads in transactions instead of 3 basis point spreads.
My goodness.
So it was a very different business at the beginning. As that became more competitive, I also took on a role at our holding company, overseeing a portfolio of private equity investments that the bank had made. As with many commercial banks, they were doing it basically to try and get ancillary business from GPs and GPs portfolio companies. But I took.
What was the year of this? Just putting it in context. What time? What year was this?
I began there doing that in 1993. And was at First Interstate doing that from 93 until 96. And ended up we had a large venture portfolio, and that was a very active time of things going IPO. And very often you would get stock as opposed to cash when there was an exit from a venture capital portfolio company. And so ended up also managing the exit process and learned the day that the lockup goes off, you don't want to be selling because all the other limiteds are selling and the price goes down. You need to wait just a little bit.
Bang the bid, just a bit.
Yes. So that when Wells Fargo purchased First Interstate, I realized I didn't want to work for a bank anymore. I'd been working at the last 10 years. I was at First Interstate. We had a target on our back as the next acquisition target. And so went to work for a group called Pacific Corporate Group, which was a gatekeeper to CalPERS, the New York City pension plans, state of Oregon, and a few others. And so I ended up getting involved in due diligence for these large pension plan clients. And especially with the CalPERS relationship, saw a lot of deal flow because we were the first line of defense, basically doing triage and saying, well, we should pay more attention to this, but the rest of these you dump to the side. And when you're getting 1,000 PPMs a year and you know you're going to make 10 or 12 investments, there's a lot of triage going on. So I did that for a fair amount.
Also, a lot of paper back at that point. I remember my credenza was loaded with with all sorts of stuff.
Yes, no email, just an inbox full of paper, which I tried to very, very quickly recycle. And a lot of into that circular recycling bin is
There
where
you
I
go.
put a lot of those things. When you're going through that sort of deal flow, and with a narrow focus on what you're going to invest in at the end of the day, that's a step you have to take. But it was truly a crash course in private equity, not only in the States, because CalPERS was a global investor. And so beginning at that point, I did due diligences in Europe, Asia, Latin America. About the only continent I don't think I've touched is Africa. But saw a lot of things during very, very interesting times in the 1990s. Then moved on to Probitas Partners. As you said, I was there for a fairly long time. Was there almost at the foundation of it, and that was a global placement agent. Began focused on private equity, but quickly moved into private real estate, private infrastructure, private debt, and so saw the whole sort of. Well, the other thing is when you're looking back to the 1990s. There weren't a lot of large investors who had tremendous legacy portfolios. And so a lot of them, the deal flow going through placement agents was very, very large at that point. Things certainly have changed over the years now where with many LPs are focused on their legacy portfolios and their current GPs. And so they very often have a limited look at what newer LPs are coming on board. So that's, I've seen major differences in the placement industry.
We'll get into that. I really want to hear some of your opinions on placement agents. I've been one since 2002, so seeing a lot of the market as well. So looking back over these 3 decades, what do you think the industry got wrong about how it would evolve? Well, back in the day, there were certain assumptions and so forth. What were they wrong about, in terms of the prediction? How did it evolve differently from the way it was expected to?
I think one of the biggest predictions was that the business would sort of remain a cottage industry, that people were selecting managers based upon a specific set of skills, and that and they were very, very heavily focused on what the track record of those individuals was with those particular deals. When you take a look at the giants of the industry now, their management companies are publicly traded for most of them, and they basically have grown into assets under management players with all sorts of strategies, usually covering all areas of the private markets. In effect, if you take a look at somebody like Blackstone, they're like the investment bank of this century, and not like the private equity players of the last century. And I remember one of the first people who really began to pursue this sort of strategy was Carlyle back in the 1990s. And there weren't a lot of people who jumped on that bandwagon early on. It took a while for Carlyle to show some success and then for it to attract people who would follow that strategy. But now the market is full of them. I mean, if you're a publicly managed, publicly traded management company, you are a large player across all markets in the private markets.
Right. Do you think they've quietly become sort of an index funds, kind of the beta of the market? And is that good or bad? I mean, you've got these, they hoover up money like crazy, and all different products. So they're always in market with something, with more than one thing. Is that the way to get beta in this market, or are they offering some true alpha or something special?
Well, the thing is, I think if you take a look at them, most of their product generates decent returns without very much volatility. So if you're looking at a $10 billion, $15 billion fund, or a manager who's had a succession of those, you don't really have a huge gap between top and bottom quartile. Now, if you look at emerging managers, first-time funds, and you look at the median returns on a lot of those small funds, as most first-time funds are, is actually higher than what the median returns you're going to see at the giants. On the other hand, the spread between top and bottom quartile is huge. And so if you're an investor...
I thought everyone was in the top quartile.
Oh, yeah. If you talk to a GP, I think 105% of GPs are in the top quartile.
It's the Lake Wobegon effect. Yeah, Lake Wobegon effect.
Right. But the thing is that when you take a look at it, one of the things I think that's also really happened is people talk a lot about the larger funds in the marketplace, the Carlyles, Blackstones of the world, that sort of thing. But I think what people haven't really recognized as much is there's also been a distinct split with the limited partners. Large LPs, because they're managing so much money, have to write checks that are like $250 million, $400 million, $500 million. And the only place that they can put that money to work is at the larger funds. The other thing is if you were at a large public pension plan, and a lot of those, the sovereign wealth funds and the public pension plans are the ones that tend to have the largest LP portfolios. If you're at a public pension plan, not as bad as at a sovereign wealth fund, the biggest risk you have to your career is Wall Street Journal risk. So you don't want to be investing with a manager who is going to make a major stumble on a large company, which is going to hit the Wall Street Journal and the Financial Times.
Right. I had breakfast with a large investor in London a few years ago, and 250 million was their minimum. And he confided that, he liked distributions because they helped the numbers, but he didn't like distributions because, damn it, he had to do something with that money.
Yes.
And it was hard to find appropriately sized things in the exposures that he wanted. So it was a real conundrum.
Yep. I think that affects a lot of the larger LPs. And so the larger LPs are definitely attracted to the larger GPs because that's where they need to place the money. The flip side of that is if you're looking at first-time funds, emerging managers, if you're looking at markets which are less efficient, the small buyout market, for example, would be one of those. You often need you have more interest in those sorts of investments by smaller LPs. But a lot of those smaller LPs, you pick on endowments and foundations, most of those are rather small compared to, CalPERS, or for example. But at the same time, they're very, very sophisticated. And they have the investment chops to do due diligence on emerging managers. If you're investing in emerging managers, I remember, maybe 20 years or so ago, there was a column in the Wall Street Journal where they had a chimpanzee throw darts at a board and then stacked up those results against an actual investment manager picking stocks. The thing is, if you're throwing darts at a dartboard in the private markets, you are doomed to fail. There's no way of getting around that.
Do you think LPs are as good at manager selection as they think, or are the numbers really reflecting access and timing, and other factors, really less related to their specific underwriting skill?
The thing is that a lot of them, the managers that I like, the LP managers, and that side of the equation, you have people who have been in the business for a long time. They've seen a lot of things. They've been burned in the past by decisions that they've made, and they get better and better at picking. Now, there's nobody I know of who has a track record of only picking what ends up being, top quartile funds. But the name of the game is to basically limit your exposure to what's going to be a fourth quartile fund or a third quartile fund, and try and move into those top two quartiles. And that is it's not just a matter of access. There are some people out there, for example. One of the things I don't particularly believe in is sometimes you've got an individual with a strong investment reputation who's a one-man band with a very, very large fund and doesn't really have the staff underneath it that really backs it up. That to me is dangerous. And I know that LPs that have been burned in that sort of a situation.
The guru on the hill. I heard somebody describe it as the guru on the hill.
Right. So, yeah.
Well, okay. So when you see a new fund come to market today, what's the most common red flag that makes you think, whoa, this should never have been launched? These guys are crazy.
It's getting to be a little bit harder these days, and I'll get back to that in a sec. But as far as the problems that arise, most of the time when you're putting together a PowerPoint pitch to an LP, it's supposed to be an agenda for a 45-minute to 1 hour conversation, basically trying to get them to the point where they're going to visit you on site and do due diligence. They're going to take you seriously. And very often, if you've got that sort of a time frame, you're talking about doing like a 10 or 15-page pitch that is concise and really hits the reason why they should invest in you and your team. Too often, I've seen pitches that are 35 pages or 50 pages, and they spend about 75% of the time talking about why the industry sector that they're focused on is a sector that you should invest in, as opposed to, well, why should I invest in you?
You.
Yes. You can convince me that this sector is really good, and there's stuff that's publicly traded. Maybe I should go over there as opposed to invest in you. And that's a common feeling of a lot of emerging managers who don't really understand the process of raising money and making the point. A pitch isn't about education. It's about getting somebody to know you and trust your ability to invest. And too often, that's not there.
Yeah. We helped raise a crypto venture fund for Pantera, who is one of the oldest folks in the crypto world. And there was an awful lot of educational kind of meetings where you get the CIO and 5 or 6 staffers, and everybody just wanted to get educated. When it came to actually making commitments, it was really the wealth managers driven by their clients that drove the actual signing of the subdocs. So if you were running a large pension today, would you increase or decrease your private market allocations, and why? I mean, they're such a big piece these days of portfolios. How would you feel about that?
Well, the thing is that to me, it really depends. It depends a bit on size. If you're a more modest size, if you're looking to invest maybe, $250 million a year, $500 million a year, as opposed to $3 billion, $4 billion, $5 billion, I think that there's plenty of opportunity in the smaller sector to pick up some managers which are good and going to be able to generate returns. One of the corollaries, though, when you're talking about the size of private equity portfolios, is that the way that the public markets have worked is that the public markets are getting smaller and smaller. They're not as large as they were. There's much more concentration. There's also a concentration of returns that happens in the public markets. And so the dynamics between the two sectors are very, very different from what they were 20 or 30 years ago. And I think that you have to take into account that when you're making those decisions, as an LP, where should you be investing your money? But the other thing is, if you look at the private markets in 1995, for example, the vast bulk of it, as far as dollars being raised, was in buyouts. If you took a look at the vast number as far as the number of funds being raised, those are in venture capital. Well, now when you look at the private markets, you have to take a look at infrastructure in its many forms. Direct private debt, which back in the 1990s, private debt meant mezzanine. You didn't really have the total wide variety of private debt product that you have now. You're talking about private real estate in all of its various forms. And for example, you also have these linkages. For example, if you're building a data center, that's very often a real estate investment. What's driving it? AI is driving it, the VC side. And you have to understand that side to make the proper investment on that real estate investment. And so there's interaction, but you also have very, very distinct pockets in the private markets, which are huge now. And for some of them were almost non-existent 20, 25 years ago.
Right. So if people have a mature portfolio, you were mentioning before, they're concerned with legacy issues. That's to be sure. So, only by increasing the overall allocation to one or more of these strategies, really, would you be able to? Everybody's got the exposure they bargained for, right? If they don't, they can go to the secondary markets. They can blame the last guy. They can do all sorts of things,
which frequently does happen.
Well, that's right. A new CIO says the other guy was terrible, and I need to package up all those bad mistakes and start over again. It doesn't happen often enough for our taste, because the mature portfolio doesn't admit very many new relationships. There's a really interesting, strange thing going on here. So, LPs have a stated interest, and you've shown this in your materials, in growth and mid-market, and still mid-market buyouts, right? And there's the simultaneous desire to cut GP relationships because they only have a certain amount of staff. They can't really follow it, and so forth. Where does that leave a new manager who's kind of in the 250 to 750 range in terms of their target size? I mean, cutting out new relationships on one hand, and yet they want to go into these growth, smaller, mid-market buyout kinds of partnerships. How do you square that circle?
I think it really depends upon, you've got to give an investor something that they're looking for. And by that, I mean, it very often, these days, it's more and more, give me a focused strategy. That's even more so on the venture side than it is the buyout side. But even on the buyout side, you have funds that are focused solely on technology or a certain aspect of technology, solely focused on healthcare, solely focused on financial institutions, which is making a big comeback as financial institutions have begun to develop not the old model of a huge building on a corner, but on the internet and generating profitability that way. So a lot of these managers are very focused by industry, and they bring to the table real industry expertise. You also have newer areas that are coming in on board, like energy transition. 10 years ago, there was no such thing as an energy transition fund. Now it's becoming more important for investors to take a look at that. And the key thing there is they don't have a legacy of large investments in energy transition. So you've got something that's different that's going on there that they're looking to add to their portfolio. One of the things I should mention about middle market buyouts, though U.S. middle market buyouts were somewhat less of a target in this year's survey compared to the past years when it had been number one with a bullet. One of the things about middle market buyouts is if you look at the history of this industry, somebody who starts out successfully raising a $250 million buyout fund and who makes a lot of money, the next fund is probably 500. The fund after that is $1 billion. All of a sudden, they're on fund 6 and it's 2.5 to 3 billion, and they're no longer in the middle market. There are a number of investors who are very focused on the middle market because they believe that it's inefficient, it's fragmented, it's not dominated by investment banks who run auctions and throw out 450 books to the world to try and get a price on something. And what this means is for those investors who are really interested in investing in the middle market, even more so in a small buyout sector or the small growth capital sector, you'd never have set the number of relationships you want to have for the next 30 years.
Right.
As people grow out, you have to look for the next good manager who's going to fill that slot. So there's sort of a natural market dynamic there that leads interest in smaller managers for people who believe that the mid-market and the small market is where you're going to get alpha.
Yeah. Well, quarterly management fees are a lot more predictable than carry. And so if you increase the AUM and even if you have to take discounts on your management fees, it does provide a pretty steady base for building a very high margin business, irrespective of the carry. Not that the carry isn't a great motivator, but asset gathering is a thing.
Well, the other thing is that it's not just the fact that the fees are steady and it allows you to build an employee base, for example. The other thing about this is if you take a look at the largest asset gatherers in this marketplace, their management companies are all publicly traded. Stock analysts still to this day have a hard time valuing carried interest. How much is that carried interest actually going to be? And so a lot of their focus is, okay, what is the fee generation capability? Yeah, I know what that is. I can go through and calculate that. And so that there is if you're the manager of a large publicly traded management company, you got a perverse incentive there. If you want to increase your stock price, you want to increase the fees that are coming into you.
Right. Well, the Pareto principle seems to apply in so many different circumstances, and here I think you can go 80% of the managers have relative trouble raising capital, and 20% have less trouble. I mean, particularly the larger ones that are the large IR staff, very sophisticated way of messaging, and they're comfy and low vol. So it's they used to say back when PCs were invented, nobody gets fired for buying IBM. And, I think the saying could be said of, nobody gets fired for Blackstone or Carlyle or something like that. And if they underperform, it's, these things happen, but it's a good big firm and they have a lot of good people and all of that. Right. So, if you've got this 80-20 split for the 80% of the market out there, which will be most of the people listening to this podcast, so let's talk a little bit more about sort of how these guys can thrive. Now, you mentioned domain expertise. Does it show in the returns? In other words, do specialists actually generate better returns than more general or those that have multiple sleeves of expertise?
Well, I think that's a bit complicated because the benefit that a generalist would have on a portfolio basis is diversification across industry sectors. For example, if you go back to the late 1990s, there were a number of growth capital and buyout firms that decided that the way that they could play the internet was to finance basically the building out of fiber that the internet was using, because that usage was going up like crazy. And a lot of the people who were playing that had the roots in the telecommunications industry. So these telecom media companies were making this big bet on the internet. And then there were a number of generalists who also dipped their toe in that particular market. When the market turned with a vengeance, and when the internet bubble burst, a lot of the generalists actually lost more money in those investments. Some of the telecom media guys were earlier in spotting, gee, things don't look so good here, took some steps to redirect some of what they were doing and the like. But the generalists very often got trashed. Now, the thing is, that was something that was very, very specific to the internet. That industry was tremendously badly hit. And so if you were a generalist with little exposure to that sector, you had maybe a couple of investments, but most of your stuff was in industrials, for example, or retail, for example. You can survive that.
You dodged the bullet. Yeah.
Right. So that in effect, if you're an LP, and you're interested in industry specialists, you also need to be a specialist by yourself in portfolio construction. You need to create the diversification that you're not getting by investing as specialists as opposed to generalists. So what you want to do is you want to invest in the best tech player, in the best healthcare player, in the best fintech player, in order to build that diversity and not really put all of your eggs in one industry basket. That's something that especially since in a number of industries, you got exogenous factors like politics that will impact you. And, though I know something about finance and investing, predicting politics is not my line. And that is extremely difficult to do and to know how actually it's going to play out.
So if you're putting together domain experts and trying to get the best of those in a diversified way, I don't know if LPs are really looking at cross correlations or those sorts of public market type portfolio construction techniques. But how are LPs really benchmarking emerging managers? It must be a pretty difficult process now. Do you do it by fund number, AUM, team history, domain expertise, size? How has that evolved, and where is it today in terms of benchmarking? It's really an important subject, and we hear LPs all the time saying they have their own internal benchmarks. Hard to say how those can be, what N is. Hard to tell how they come up with that. How is this whole benchmarking thing, work into the problem for LPs?
Well, I think that, and there's a couple of things that are going on here. First of all, when you look at benchmarking, one of the things my survey says is, on average, the LPs who responded to the survey used 3 different methodologies or services. So that it's as if, somebody's using Preqin and Cambridge and private public market equivalent analysis to benchmark what's going on with their portfolio. They don't rely on a single benchmark. Back 25 years ago, when venture economics still existed, a lot of people were using just venture economics.
Stan Pratt.
Oh, yes. Back in the olden days. The thing about it is as well, I think that benchmarking is very useful. If you're using a standard benchmark for middle market buyout funds in the U.S., which you can easily pull off a Preqin, that they don't have specific slices, say for technology. They just have general middle market buyouts. If you're an LP, one of the things you want to try and do is build something you think is going to be better than that overall benchmark by making those selections. And so I think that to benchmark performance, usually one of those standard benchmarks is useful. You want to be able to see whether or not you can get outperformance. Now, the other thing is, though, that you have to be able to be flexible. Perfect example of this. If you're backing a first-time venture capital fund, it's an early stage fund. An early stage fund, basically its portfolio takes more time to develop. So that when you get 3 or 4 years into it, you're not going to have realized investments. So, for example, DPI makes no sense if you're looking at that first-time manager. But what you're looking at is, okay, what investments has he made? Did those investments that they told me about when they were marketing the fund match the strategy that they said they were going to be doing? And then subjective factors, such as, am I getting transparent reporting from them on a quarterly basis, which is timely? So I can actually have a viewpoint on what's going on. Or there was, I know back in my days at CalPERS, there were a couple of managers who literally, they had 90 days to deliver a quarterly report, and they gave you the quarterly report on day 89. But basically sort of like actions like that bring into the whole equation the matter of trust, because you have to trust that what you're getting actually makes sense. But especially so with a VC. To me, if you're investing in a first-time VC manager, you're making a two-fund bet, unless they really go off the rails as far as doing what they said they were going to be doing. You shouldn't be expecting to have returns by the time Fund 3 comes around. You should be expecting to have returns from Fund 1. But it really depends upon, okay, what sort of strategy are you backing as an LP, and what dynamics are important to you in building it. And a lot of it just isn't the hard numbers. I can't stress more the matter of trust, which is, and there are a number of GPs I know, less these days than there were 25 years ago, who would visit their LPs every 4 years when they were raising the next fund, and not doing very much in the interim, in order to build a relationship with a limited partner. GPs talk a lot about LP relationships, but sometimes the execution isn't there.
Right. Well, what's the most uncomfortable truth about first-time funds that GPs don't want to hear and LPs don't want to say out loud? I mean, what do you think? I mean, first-time funds, everybody's got an opinion.
Well, the thing is that one of the uncomfortable truths is, and that's one of the reasons why due diligence is so difficult, there are certain investors who literally aren't cut out to be fund managers. If there's a skill set in managing a fund which is different from investing, and most people on a first-time fund have worked as senior, maybe not the most senior, maybe not at the partner level at a previous fund, but they've been a principal, they've directed investments, they've served on the board, they've hired and fired CEOs, they know all that. But some of them don't really understand how you manage a fund and how that's different. And that goes into portfolio management. It goes into, human relations, basically motivating your staff in the correct way, so that there is a way that you invest correctly, and that's instilled throughout the entire organization. Managing people in that situation is different from being an investor. So so trying to come to grips with that is difficult. And the uncomfortable truth is, as I said, if you're looking at first time funds, the spread between top and bottom quartile is large. But if you look at the minimum return, I mean the actual bottom of the stack, it's negative. To me there are a number of managers who simply prove after their first fund
that they're not cut out for it.
They're not really a manager, and you have to be. And if you're doing due diligence, you have to be really careful about this. Even if you're looking at, because emerging managers really go into second-time funds and third-time funds, they're still sort of proving themselves. There was one venture capital fund that I was doing due diligence on back in the 90s, in the 1990s. And in venture economics, this fund had the highest IRR in VC in the 1998 vintage. When you dug into the numbers, usually with VC, I'm going to expect if you made 10 investments, you probably wrote 2 off. You've got 3 that are going to, be slightly underwater, or you just get your bait back. You're going to get, 3 or 4 doubles, and you're going to get 1 or 2 screaming home runs. This particular fund, when you looked at it, it had 1 screaming home runs, and 80% of the portfolio was underwater. Well, the thing is that, and they weren't the leader on the screaming home run. The lead GP had a relationship with an established VC who allowed him to put money into this deal, and he wasn't like a driving factor on the board or anything like that. When you came around, they were able to successfully raise Fund 2 on the basis of people who looked at the top line number, didn't dig deep, they made the bet. And what Fund number 2 proved up was that 80% write-offs was probably right. And it was totally luck with the 1 screaming home run. And that group was never able to raise Fund 3.
Yeah, our experience is we look at the Fund 1s and they're difficult. They're more difficult than anything. Fund 2, if the Fund 1 shows some pretty solid interim progress, you can raise money off that, even if it's just illiquid TVPI kind of stuff. But where you get to Fund 3, the rubber has met the road. Now you got to go back and look at Fund 1, and oh my gosh, now you really see what's happening. And either the holding periods have extended and they're just kind of bubbling along, and oh my gosh, what do I do now? Or as is typical, you've got some good stories, some bad stories, and some neutral stories, and it becomes really hard for investors to take a look at a Fund 3 and really understand what happened. But with a Fund 1, it's all a blank sheet. You've got to have some measure of principal investing experience. So if you were advising a talented spin-out team today in venture, should they be looking for friends and family kind of investment, do sort of a deal by deal independent sponsor kind of a route, or should they wait for the next cash cycle to improve, and then we'll do that in a buyout and a growth kind of strategy? I don't know if your advice would be different.
Yeah, on the venture side, to me, it really, what do they have as previous investing experience, and how much of that is disclosable? Do they have an attribution letter from the GP they worked at before? And that can be very, very hard to get. Or can they reconstruct a track record? For example, if they were the lead person on the board of directors, for the VC overseeing that investment, and what sort of recommendations can you get from the CEO and CFO of the underlying companies? Can you construct a track record which looks strong? The key corollary to that is, okay, how is the team that you got constructed? Have you ever worked before with the other team members? The underlying question is it really a team, or is it a group of people who have some thoughts about raising money? Because the process of fundraising can be very, very hard, and it is not unusual for groups to break up during fundraising if they don't really have strong interpersonal relationships. So that's very important as well. Now, the less relevance, the less heft you can bring to your track record, especially and your interpersonal relationships, very often my advice is to go the independent sponsor route. You say that this group of people, maybe you never invested with them, but you went to college with this guy. Fine and dandy. Go off and be an independent sponsor. Do 2 or 3 deals at the very least that basically prove up your strategy, but also prove up that you're working together as a team. And that is, I think, is one of the keys. And it doesn't matter if it's VC or buyouts or growth capital. Do you have a real due diligenceable track record, and do you have a track record of working together?
Right.
So.
Well, are independent sponsors the vanguard of a structural shift, or is it just a temporary workaround for a tough fundraising market where it's all going to at some point normalize when the cash cycle becomes a little more normal in terms of distribution, or a little more like the historic cash cycle, put it that way?
Right. The thing is that I've seen an increase in interest in independent sponsors over the last decade. So I don't look at this increase in interest being something that's popped up over the last 3 or 4 years based upon the fundraising difficulties. I actually take a look at this in a little bit different way. If you take a look at what LPs are looking for, one of the things that LPs are looking for is more control over investments, and perhaps lower fees as well. And they've been doing that increasingly over the past 25 years in co-investments. 25 years ago, you almost didn't hear the word co-investment. Now, you began, 20 years ago or more and more interested in co-investment. Well, the thing about a co-investment, to do it successfully as an LP, you have to have a team of people inside who are making a bet on an individual company that's being brought to their attention. It's totally different from investing in a blind pool. It requires a different skill set. But if you can do the due diligence on a co-investment bought to you by a fund manager that you backed, you have a lot of the skill set needed to take a look at what the independent sponsor is bringing to you. So I look at the growth of the independent sponsor as a natural progression of the private equity market as LPs pick up more and more skill sets. And it's not all LPs, but a significant number of LPs have made the bets to build staff that can look at individual deals and make a decision. And the thing is that not all deals are created equal, even if they're a co-investment alongside a fund manager. Sometimes they're trying, there are ulterior motives that they have, and it may not be the best deal in the world. So as far as I'm concerned, you must do the due diligence. But that skill set, if you build that skill set for co-invests, it's the same skill set you need to do on the independent sponsor side.
Right. Well, there are a number of independent sponsor commingled blind pools where you have professional managers who are providing the capital and other sorts of value add, and the independent sponsor who needs the capital, but who has the relationship with the seller, or if it's growth, with just the owner. Right. And how does that model work? I mean, doesn't it seem like the independent sponsor is going to add more expense and more, a double layer of expense, or you got to pay them. They've got to share in some kind of upside. They got to get some kind of current comp, usually, directly from the company. How does that work for a blind pool who's investing using capital, that they have in a commingled partnership, investing alongside of an independent sponsor who really doesn't have much money? I mean, they may roll their fees or whatever into the deal, but it just seems like, why does that work?
Well, I think there's a couple of reasons why it works. First of all, most independent sponsors are on the smaller side. A number of them are focused on particular industry segments. They're usually not. Some of them are very narrowly focused. Others are more active in 2 or 3 segments, and they really try and understand those segments well. They try and build contacts that are useful in doing, for example, buy and builds, and deeply understanding that industry that they're taking a bet on. The thing about the how you get paid, that's really different about an independent sponsor is, and I should say, there's all sorts of negotiations all over the map with independent sponsors. Some of them are almost like no fee, no carry, but they're getting some action out of the underlying company as opposed to having the LP, pay for it. And so those levels are all over the place. But one of the biggest things about an independent sponsored deal, it's a benefit to an LP, is you're paying a management fee on money that's invested in the ground. You're not paying a fee capital based upon committed capital, which can take 3, 4, 5 years to actually deploy. And so there's an inherent benefit to only paying for what's actually going into the ground on the part of the LP. Now on the GP side, there's another factor. If you're running a fund, you're more likely going to be making 10, 12, maybe 15 investments in that fund. Your carried interest basically comes at the fund level. You can lose a couple of companies and still generate carried interest.
Yeah, the independent sponsor doesn't have that luxury.
No. You're doing it deal by deal. And if you mess up on a deal, you've messed up on that deal. And so the dynamics between how this money gets managed is very different. And I will say now that there's one big benefit that a fund has. They can just go ahead and write the check.
Right.
Whereas the independent sponsor has to go out and raise the money deal by deal.
We have a client that we're onboarding right now who is totally focused. 80% plus of their capital has been for the last couple of funds independent sponsor driven, and one of the things that I was at their annual investor meeting in London a few weeks ago, and the woman I sat next to is a former Carlyle partner. She got tired of the big business that Carlyle was as opposed to being something entrepreneurial. She's a manufacturing expert, loves the factory floor, precision manufacturing. She's got a deal that's a spin out. Carlyle for 21 years. Now she's an independent sponsor. This is going to be really interesting, because this is a very well-trained and experienced person with specific domain expertise and the kind of credentials that, she could go be a partner anywhere, really. And she's an independent sponsor.
Yeah. One of the things I think is interesting is, say 20 years ago, I think the bulk of the people who were with independent sponsors were looking to build up a track record so they could raise a fund of their own. And I think that there are becoming to be more and more, I don't think it's the majority, but I think there are more and more people who like the degree of freedom that they have as an independent sponsor and are not looking to eventually raise a fund. But the key thing is they have to have, just as a fund sponsor has, a track record of success. It's in order to raise the next deal. Because if you're looking at an independent sponsor, you're looking at the deal, but you're also looking, can this person execute the strategy? So you got that combination is always very, very important.
Right. They used to be called fundless sponsors. And I sat on a panel, Bert Alamansky, if you'll remember Bert.
Yeah.
This would be, 20 years ago. And I asked the panel of independent sponsors, are they interested in raising commingled funds? And only one of them said yes. So I think this has been something that's been cooking in the back of the head of these folks for a long time. Being independent. Now, they have to have capital to make these deals work. And not everybody who's working full time as an independent sponsor, can broaden their investor base sufficiently to fund every deal. So it seems to me there's a place for commingled blind pools to invest alongside independent sponsors. What do you think that's accurate? Do you think that's true?
I do think it's true. It all depends upon. There's so much diversity in the market now that there wasn't before. People, in order to almost to raise private equity back in the 1990s, you had to be raising a fund. That was the way you did it. Nobody else, and so now there are so many different ways to approach deals that and the other thing that I think the survey shows is that the pool of LPs who are willing to back an independent sponsor has increased. I've noticed that over the past 3 or 4 years in the surveys, to the point where now the number of LPs are saying they would rather back an independent sponsor with a deal rather than that as actually trying to make the transition to a fund. They'd rather back that person than back a spin out. So that there's much more interest in what the independent sponsors are doing, either as a step to raise the fund or simply, this person really understands this market segment and this deal looks very interesting. But more and more LPs are set up to write them a check. So that I think it's getting, and actually there are more and more placement agents that are willing to help independent sponsors target LPs.
Yeah, and our experience is some of that. We've seen family offices who used to invest in commingled blind pools, and who then, exclusive of the industries where they made their money, attempted to begin doing direct deals and found two things. One, the skill set they thought they needed, they didn't have. The people that they thought that were going to do it well weren't particularly good at doing it well. And so they end up with these, zombie companies where they put a lot of money in and it's not growing fast enough and there's a bunch of debt on it. It's not losing any money. It's not making any money either. And then deal flow. They're finding it really difficult to get higher quality deal flow that they can underwrite and then manage successfully. And we see a slow turning to having at least a few commingled blind pool relationships. So that's one thing. The second we've seen is that overwhelmingly, and this may change, subject to change, but overwhelmingly, LPs will co-invest with their GPs, but have a real difficult time looking at deals that are not sponsored by somebody they know, not sponsored by one of their relationships, their GPs. And they just they're not set up to do it. And they say, because we brought them deals, and they say, we only invest with our GP. And that's a huge piece of the market. I mean, 75% of the folks who we show something to have told us we only invest with our managers, only co-invest with our managers.
Mm-hmm. Well, in the survey, I sort of asked that question, do you only invest in alongside managers? And the response, I can't remember right offhand exactly what the response number was, but the people who would only invest alongside a GP they had a relationship with, that response was about half the amount of people who said they'd invest in an independent sponsor. So I think that one of the things we're seeing is more of a shift to be open to independent sponsors, sponsor-led deals. But traditionally, 10 years ago, I think that was absolutely the case. And the other thing is you do have this dichotomy between what senior investment staff in a private equity department is willing to do and what the CIO or the board is willing to do. And the CIO or board very often are the ones that would set a policy. No, we're only going to do co-investments alongside GPs that we know. I think that there's more flexibility at the lower levels. And as some of those people move up, I think we see more and more change happening, more and more acceptance of that.
Yeah, there's a career issue there too, right? The closer you can get to being a principal investor, the better it is for your overall profile. You get paid more.
Exactly.
So, if you can be a direct investor without the mediation of a GP or a sponsor in between you, that marks you as, if you're successful, it marks you as a successful principal investor, and maybe you could even cross over to the dark side and become a part of a GP organization.
Yes.
So, what do you think the most overhyped innovation in private markets that you've seen in the last decade or so, and what's the most underappreciated? What's the most overhyped and the most underhyped, if you will?
As far as the most overhyped, I really have a fear of retail, and that comes from long experience. I basically, when I was working for a gatekeeper, helped to raise two fund of funds, utilizing DLJ as a placement agent. Tells you how long ago that was. At the height of the internet boom, and one of the things that we found out was that, and testing the waters, I'm not sure how much this has really changed. Retail, especially the lower you go in retail, really does not understand the lack of liquidity. And in this market, one of the things you're getting paid for if you're a private equity investor is an illiquidity premium that happens in the marketplace. They don't understand it. The other thing is that if something goes wrong with the investments, it's not, I didn't do anything wrong. It must have been that person, and therefore I'm going to sue them. They tend to be much more litigious
right.
than institutional investors. The thing is that we've been in a period over the last 12 years or more where the markets, except for small blips, with the original Russian invasion of Ukraine, with COVID, those small blips were not major market downturns. It's been a long time since we've had a major market downturn, so everything is up and to the right. I don't think that retail really truly understands what these markets are like, what illiquidity is really like, and the fact that that when you take a look at the kind of bells and whistles you have to put on structures to get retail in, they are paying a large amount of fees, totally different from what's going on with institutional investors. And so I think that I don't think the law of gravity has been reversed. I do think we're going to have a market downturn, a major market downturn. When you take a look at history, it comes around every 8 to 10 years. I think we're almost overdue. And basically, if you have that major downturn, all of us and the private equity industry gets tagged with having taken advantage of retail. I think that's dangerous for the industry. That's my opinion on that.
So you had mentioned that increasing competition is decreasing opportunities for significant returns across lots of areas of private equity. Can you expand on that a little bit? You mean competition for deals, right? Or competition in some other arena?
No, basically competition for deals. And that I think more and more GPs are having to pay up to get decent deals done, or they're lowering their standards to get deals done because there are so many people out there competing in the marketplace right now. When you mentioned earlier in this conversation, the worry should LPs be putting more and more money into private equity. The thing is that my answer was more about the comparison to the public markets. But when you take a look at the amount of money that's going into private equity, the number of funds being raised, the number of new entrants coming into the private markets, that means that the competition is only becoming stiffer and stiffer for getting deals done, that may be one of the reasons why we've been having this pause in fundraising amongst institutional investors anyway over the past 4 years. They're not as convinced as they were before that they were going to be getting strong returns.
So it's less DPI and more convinced simply that reversion to the mean, if you will, because deals are increasingly difficult to get at good prices?
Well, I think that's true of private equity, but there's also a number I saw sometime in the past week or two. When you take a look at the returns in the equity investing markets overall, including the public side, we have had a hell of a period of 12 years, 15 years or so, that really everything seemed to be going right. Everything was really sort of up and to the right. I know that one of the senior people at Goldman Sachs came down with a statement that when he forecasted equity returns, and that's both sides of the equation, but equity returns over the next decade are more likely to be 6.5%.
Mm-hmm. Mm-hmm.
So that the thing is that private equity is not immune to the factors that affect the public markets as well. But I think we've been coming off a period where literally everything that could go right went right.
Right.
And that usually doesn't, continue ad infinitum. So.
Right. So if you had to give some brutally advice now to LPs and GPs in sort of a single statement, what would you tell them now?
I guess on the GP side, there are a number of GPs, I think, who are trying to chase the newest trend. My advice is stick with what you know well. And unless you really, really know something deeply and understand it deeply, don't follow what everybody else is doing because everybody else is doing it. On the LP side, to me, it's almost easy to spell out the phrase due diligence. You need to tear apart the information that you're given to make a decision as to whether or not a GP is trustworthy and the GP has the ability to make good investments, and that, whatever's in their track record really reflects the totality of what they're able to do.
Right. Let's switch focus for kind of the final theme of this thing. I'd like to talk about the placement agent business a little bit, something that you know a lot about and I know something about a little bit. So first of all, if you were designing a business from scratch today, knowing what you know, what kind of a placement business would you build, if at all, and what would you not bother doing?
Back in the 1990s, when I was getting into this business, at that point in time, private equity was really increasing, both buyouts and venture capital. And most placement agents were focused either on private equity or venture capital. So mainly buyouts. It was a steadier sort of business, but there was a focus on that. To me, these days, as a placement agent, you have to be aware of the fact that market factors going forward are going to change on you. So that, for example, for the past 2 or 3 years, 3 or 4 years, private real estate has been ice cold. It could be, for example, that with data centers becoming front and center, that business could be increasing. So that one of the things you have to do is have a degree of experience, I think, across all of the private markets, all the private markets for closed-end funds. The hedge fund business tends to be a very, very different sort of a business as far as the dynamics and the process of fundraising.
We spent 7 years doing both private equity and hedge funds, and decided hedge funds were so different and different from what we had ever done previously, that
Right.
After we learned about Sortinos and Sharps and monthly returns, we cut it off and stopped it. We did raise a bunch of capital, but not our cup of tea.
Yeah. But when you talk about closed-end funds, there are a lot of similarities with real estate closed-end structures, infrastructure closed-end funds, private debt. And one of the things that as a placement agent you have to do is, we mentioned briefly in passing education. in this business, as a placement agent, your business isn't to educate. Your business is to raise money, and you can raise money most efficiently for a GP if you have a base of LPs that you know well and understand well, and you know which areas they're going to be going into, and which areas are going to be decreasing in interest, and which areas are going to be increasing. Now, one of the key things is, especially if you're looking at the larger LPs, those areas of private equity are siloed. And so you have to have conversations with the buyout guy, the real estate guy, the infrastructure guy, in order to get a total picture of what the appetite of that
Well,
LP is.
and those things change. I mean, not just at the
Yes.
pacing meetings that are taking place right now, but they change. I called on a guy, an LP whose name will go unmentioned, and I did the usual dance, trying to get in front of him, trying to get some attention, and finally, after I don't know, it's probably 5 or 6 months after the initial touch, he came back and he said, "Oh man, I wish I'd seen this 3 months ago. We just committed." So I see this very crowded market out there. I see mature portfolios that, unless they're going to not re-up and they still want that exposure and they're going to try and find it somewhere, or there's something where they've made a conscious decision to move into additional exposure, or there's something new that they need to know, understand, and maybe get a taste of. We just see it as being an extraordinarily opaque and difficult thing. These guys and gals have, thousands of folks knocking on their door all the time. It's sad to say that it comes down to your subject line in an email. But we've had LPs who've committed, 20, 30, $50 million to our clients, and you go and try and talk to them, and they just, there's no way you can have that conversation. And so as we look at it now, is the placement agent model sort of structurally broken for smalling and emerging managers to try and get some attention from these folks? They seem overwhelmed. They don't respond. The most popular thing I did at Super Return West this year was I had a bunch of GPs on the stage, and I was talking about, well, now how often do we send out emails? How often do we make a voicemail? How often, what do you do with this? How much, the actual nuts and bolts mechanics, because it's just so darn difficult. Do you have any interesting or important observations on that as to how GPs might go about this if they're doing it on their own, or placement agents for that matter? How do you break through the static?
Well, the thing is that I think placement agents serve a useful function, and I guess most especially a useful function for emerging managers. And I think one of the keys there is a lot of emerging GPs have been at the principal level or the junior partner level. And so they've been actively investing, but they don't really interact as much with the LPs as the senior partners and the senior partners in the IR staff. They don't really understand what LPs are looking for in general. They don't understand what hot buttons LPs have, especially institutional LPs. And so I think one of the things you need to do is hook up with somebody who really understands how LPs think, how they're going to look at your pitch, how they're going to look at your idea. I think that that key function that should be the key function of a placement agent. And it's something that, as long as there are emerging managers, I don't think that need goes away, because these people just need to be sort of trained up to do it correctly. The other thing is that when I was at Probitas, one of the reasons why I was doing this survey on an annual basis, I always saw myself, if you think in military terms, that the relationship managers at my organization were the infantry. And I was a combat engineer who was trying to help them break through to the LP. And doing things like this annual survey means you can have a conversation with an LP without a GP in tow and generally talk about general market conditions, what you're seeing as a placement agent, what the survey says other LPs are doing. And you need to have that conversation to build a relationship. And one of the key things is if you can, as a placement agent, if you're doing something like that, if you're taking that approach, the LP is much more likely to pick up the phone when you call.
Right. Yeah. Some people actually start podcasts for that purpose.
That's true. That's true. But you have to give the LP much more than, gee, I've got the ABC fund for sale. Don't you want to buy the ABC fund?
Yeah. Well, what do LPs expect from agents that most GPs underestimate or misunderstand?
Over my career, there have been a number of GPs who hired us, and I know that hired other competitors of ours, and they looked at them almost as a travel agent. You need to get me meetings, and you need to contact all these people and get me meetings, and then you need to put together the road trip, as opposed to providing any real advice on, if, for example, one of the reasons why we were doing the survey to talk to the LPs. Great. Why do you do that? If you have somebody who actually an LP who hates impact and sustainability, why in the world would you ever take a GP selling an impact fund to that LP?
Right.
On the other hand, what you're trying to do is, taking this back in the olden days when I was more of an investor, there were a lot of placement agents out there back in the mid 90s who would mail out 500 PPMs willy-nilly to everybody on their list to see what stuck. That doesn't work anymore.
Right.
You have to figure out which LPs actually might have an interest in this strategy, and that's what you go after.
Right.
And I don't know if the GP is looking for somebody who's going to be a travel agent really understand that.
And less so today with Zoom. The roadshows we put together in the U.S. for our European clients are meaningful in the sense that there isn't as much chance for FaceTime, but they're all preceded by at least one or more Zoom calls at this juncture. So nobody's now I say all. If we have an anchor meeting with somebody who's had a few Zoom calls, wants to do the work, and there are two kind of sort of meetings in the same city, we'll do those meetings in person because we're going to be there. But generally, the travel agent thing has greatly diminished, and my travel, for example, is way less than it used to be pre-COVID.
Well, I do think that there's still room for I think there's still an importance of the LP meetings. After COVID, everything during COVID was in Zoom, and I think there's been a bounce back, in part because I think one of the important things that LPs are looking for is this a person I can trust? And I do not believe you can judge that trust factor in the same way on a Zoom call.
Over Zoom. Yeah.
So, now, I think you may have Zoom calls as a preliminary to get a physical meeting.
Right.
But I think the people who are really going to be putting money in are going to want the physical meeting.
Oh, that's our intention. Is the Zoom calls are just a prelude.
And there's one other thing though is you mentioned if you're going to be showing up in a particular city, you would perhaps add on some calls to people who may not be want to invest in this fund, especially with emerging managers. There are LPs out there who would never invest in a first-time fund, but they're wanting to map out second and third-time funds. And so they will take that meeting. Now, that's a meeting that's probably worthwhile for a GP taking if they totally understand where that LP is coming from and what the name of the game is. And I wouldn't necessarily go to a city just to do those sorts of meetings. But I've got a good prospect, and I've got 2 or 3 other people that I could be building up a plate for this GP for the next fund. Yeah.
So does AI have a role to play in marketing funds these days? And if so, kind of what is it? And then, allied with that is AI likely to disintermediate? My view is sort of that humans this is going to be one of the last things that humans will give up. We don't necessarily want investment decisions being made by an agent, either a placement agent for that matter, or an AI agent, really. So how do you see AI impacting fund marketing?
I don't really see a lot of impact currently on high priority clients. The thing is that when I sit down and talk to an LP, or one of my colleagues at Probitas would sit down and talk to an LP, you're getting views on what they're thinking about the market that have not been published. And what they're trying to do is bounce ideas off of you as well as what else you're thinking. And so you have this interactive relationship that is not captured externally in sources that AI usually taps into. And it's specific, AI could be used, for example, to duplicate my survey, but it can't duplicate that one-on-one interaction and sharing of information and the thought process. So I don't see it as having a dramatic impact on placement agents right now.
So big trends. A number of things in your survey were pretty interesting. Certainly the increase in interest in growth strategies I found to be sort of an interesting thing. Certainly the independent sponsor interest, and then there's the pan-European buyout thing. Is that? I mean, it's a big number now. I think 14% to 40% or something like that.
And that was 14% to 40% among North Americans. So, and I think one of the things that's driving that is that North Americans are looking to diversify their portfolios a bit more. They're seeing more activity in Europe, which is maybe not the same kind of activity they're seeing in the States. It's a less crowded market as far as funds are concerned. And so for North Americans who don't really know or understand the middle market players that are operating in the UK, or the middle market players that are operating in Scandinavia, the easiest bet for them to make is, gee, I'm interested in Europe. I'm going to go for a pan-European fund.
One-stop shop. Yeah.
And so I think that's part of what's driving that right now. So, and interestingly enough, if you take a look at the survey and you take a look at European respondents, their interest in pan-European funds is way down the line, and they're more interested in small buyout funds in Europe and small growth capital funds in Europe.
So growth capital, what's the push there? Why growth?
I think one of the things that's really driving that is the venture capital business. Because in venture capital, you have so many of the very, very successful firms not wanting to go public, not wanting to do a final exit off of the VC stage by going public. They're holding on longer, but you've got these companies which are growing very, very rapidly now.
Oh, you mean the K rounds? L, M, N?
Well, the thing is, you switch it off, it gets to the point they're large, they've got established revenue, and so they become really a growth capital investment as opposed to a VC investment. So that they need more capital for growth, they're going to tap into that source. And I think that's what's driving that right now.
But historically, there's been two kinds of growth investing, right? There's the growth investing that's taking more where technology is not necessarily the mission critical thing, and they're growing at 15, 20, 25% a year, first institutional capital in, those kinds of things, where it's a minority position, even though you got good covenants and all of that. And then there's the growth capital, which is really late stage VC, whatever kind of round you want to put on that. Do you see those things converging, or is the former not really of interest in terms of growth, or you know what I'm talking about in terms of the sort of
I think both of those things are happening in the marketplace, but the number of items, the number of companies that are growing very, very rapidly, which are not technology related, I think there's a limit to those ideas. And so there are a number of small growth capital firms very focused on that particular area, in industry, in retail, and all the rest of that. But that doesn't expand as quickly. I think you mentioned, is it late stage capital, venture capital, or is it growth? The thing is, when the founders of these companies that are growing so quickly, because they refuse to take something public, they want to retain the control. When you take a look at something, it's hard to say that that's venture capital anymore when you've got large established revenue coming in on board.
Different order of magnitude.
A different order of magnitude at all. And I think that is attracting, more interest. And you've got a number of VCs, of course, who have now raised separate growth capital funds, whereas the old growth capital really was, and it still exists, more allied to the buyout side.
That's exactly right. I had somebody come to me when I was advising the Pennsylvania public school employees as their first consultant, Phil Smith. Maybe you remember Phil, Citicorp Venture, way back, Peter Gary days. This dates me back into the 80s. And he and his partner had come up with something called PEP, Private Equity Partners, and it was growth. And I thought it was intriguing, but PCERS did not. So I never really did, work the file hard. But
yeah, well, the thing is, if you went back to that period of time, throughout the 90s, there were a lot of LPs that wouldn't touch growth capital because a lot of it was minority investing. Because the guy that owned the company needed capital for growth, but didn't want to give up control until he built it to a certain point 4 or 5 years later. So literally, growth capital 25, 30 years ago was almost a dirty word amongst LPs.
Yeah, no, that's true. So taking off on from your latest survey, what other kind of big observations could you make about the changes that have taken place in the last year between last year's survey and this?
Well, the other big change is a decrease of interest in AI investing. Especially if you look at the first half of this year, or for the past 3 years or so, but through the first half of 2025, you've had a tremendous amount of money going into AI-focused funds. This AI went from being one of the leading sectors of interest last year to a trailer. And I think that's in part because I think a lot of people have made their bets in the sector and are waiting for their bets to play out.
One way or the other.
There's a lot of activity here, but then there's not a lot of exits and money coming back yet. And interestingly, if you parse that feeling by geography, North Americans and Europeans are the least interested in AI, and they've been more active in the past that they've made their bets. And the area that has more interest is Asia, where it's more of a newer sector, and they don't have as much legacy portfolios. So I think that's the dynamics of what's going on. But it was distinctly noticeable, the fall in interest in AI.
Yeah. No, I think you're right about that, because virtually every venture manager out there has pivoted in one way or another to AI. And many of them, based on my incomplete data, but they seem to be struggling with the legacy bets they've made in prior funds, trying to figure out how they can take advantage of or avoid being killed by the AI competition. So it seems like there's a lot of focus right now on protecting legacy assets by shifting into AI-driven kinds of strategies, trying to figure out how to retrofit AI onto a SaaS strategy, for example. A lot of that going on. We've seen how Salesforce has done in the public markets. Everybody and his uncle thinks maybe they can do a better job of creating a Salesforce CRM than Salesforce, and maybe they can. Salesforce is a mighty complicated platform, and as such, it's generic and not specific. And so if you need a specific CRM, maybe the market is right on that one. I don't know.
The other thing is when I look at AI, I think back to the internet investing in the late 90s. This was an extremely hot sector and tons of money went into it. And the argument was being made that the internet would be transformative. It would change the way in which we were doing things. And that was absolutely true. But then you get to the question is, who's going to make the money off of it?
Right.
And who is going to end up losing money because some of the first movers are going to eat your lunch and your, I think this is the same sort of dynamic now. I think AI is transformative, but the real question is who amongst all the various players here are going to make money and who are not.
We are representing a first-time fund, former head of Qualcomm's chip business, coupled up with the former head of McKinsey's tech and telecom practice. And they have operated a dual family office since 2017, done 30 early stage deals, pretty similar to what they want to do in the blind pool. And it's totally about enabling technology. So we're talking reducing latency, interconnect, sensors, better data management, better data, all of the stuff that no matter who wins, that they will win. Unfortunately, we've also found that the LP market has said, this is really interesting, and these guys are really qualified. And yeah, they've invested $800 million in corporate venture, and yeah, they've invested $35 million of their own money, and yeah, they're probably in the right strategy. But you know what? We got all we need, thank you. And so it's an interesting challenge. I do think picks and shovels are sort of the place where you're going to find that everybody needs them. And so kind of no matter who wins, the picks and shovels will win. You push stuff out to the edge. Nobody wants to wait. So latency is always an issue, those kinds of problems.
Well, I know one of the areas in AI, which I firmly believe in, is on the medical life sciences side. It does a hell of a lot better job of analyzing imaging than human beings do. And what you end up doing, of course, is use the AI to say, oh, what about that spot? What about that spot? And you don't get a lot of false positives, but then you have, then the physician goes in, takes a deeper look at those areas and comes to deal with it. But it's, that particular task on reading imaging is AI does a tremendous job with that.
Yeah, there are going to be a number of things that emerge as critical AI sorts of things first. And nobody knows where all this data center stuff is going. It's, thus far the math seems to show that the curves are going to continue to be predictive. But who knows? It's really up in the air. If you had to go back to Kelly DePonte before he began his career in private equity and give him some words of advice, what would that be? What do you think you'd want to whisper in the ear of a younger self?
That's I guess that's sort of difficult to formulate.
That's why I didn't tell you about it ahead of time. I like this question.
Yeah. Well, I came from a lower middle class family in Hawaii growing up, where I didn't have much exposure to the business world at all, and so and then graduating from high school. I think I graduated from high school the year before KKR launched its first vehicle. So private equity was certainly not on my horizon as I was growing up. And, for me, I actually sort of stumbled into private equity. The bank that I was working for basically had decided that private equity was not core, but it had a portfolio of $200 million and 15 different funds that they needed to have someone to manage. And I was also managing out an exposure that we had to interest rate swaps. And they said, well, Kelly, why don't you go ahead and do this? And I became totally fascinated with it. And I had a chance to, looking at this from an NLP perspective, off of those 15 funds, I ended up being on the LPAC of 4 of them, and really began to take a look, be able to look at the inner workings of how some of this stuff worked, how GPs worked, and then the whole process of selling stock that I was distributed instead of cash, gave me another viewpoint of the marketplace, and we had a lot of venture capital stuff, so a viewpoint into the developing technology that was happening at that point in time.
So what advice would you give that young man? Maybe nothing. Maybe you don't have any additional observations you'd like to share across time.
The one observation that, two. First of all, I think it is best to start out sort of in the bowels of something and really begin to understand it before you launch and decide, okay, yeah, this is what I want to do. And I'd been with the bank, managing the bank's portfolio for 3 years. And then when the bank was getting bought, I decided, okay, private equity, that's where I want to be. But I had that knowledge. It wasn't, I read something in the Wall Street Journal about KKR and wanted to get involved in private equity. So I think that trying to get involved to really understand something deeply is one of the things that you need to do. The other thing is that I should have told myself at an earlier date, you always have to be flexible in your viewpoint of how you view your career, what might be hot buttons for you. I started out after graduating from business school going into banking because I thought I knew something about banking, and then ended up going into interest rate swaps, then going into asset liability management, and then going into private equity. But these were opportunities that popped up on my radar screen that resonated a bit with my background, and I felt was worthwhile getting deeper into it. And for example, I spent 3 years in the as an advisor, internal advisor on the asset liability committee at the bank. And it's become very, very useful when I'm talking to LPs about portfolio management. It's one of those, you never know how the pieces are all going to line up.
Yeah. Well, Kelly, this has been terrific. I appreciate your patience with my questions and value your insights. Maybe in a year's time, we can do this again and take a look at the survey from next year and see what the heck has happened.
Yep. That's a good plan.
Terrific. All righty, man. I will see you around because we always do. Thanks so much.
Okay, Tim.
Okay, take care.
Thank you for listening. Please visit us online at touchstonegroupllc.com.